Good afternoon, everyone. Welcome to this TradeStation webinar. Thank you for taking time out of your schedules to be here and learn a little bit about options trading. Today, we have a guest speaker, Brandon Wendell. He's a trader, mentor. He's not affiliated with TradeStation, but it's always a pleasure to have him to talk a little bit about options strategies. This session is a recurring session, options replay, and we talk about trading examples, things that could have worked, or things that were trades that didn't work, and the reasons why it worked or didn't work. So it's a great way for us to look at option strategies from a practical standpoint, and that way you have all the details associated with those trading strategies. Let's go ahead and go through some disclosures before we get started. Keep in mind that every symbol and example that we talk about in this demonstration are just that examples. TradeStation doesn't make any sort of recommendations. Also, that active trading is not suitable for everyone, and past historical performance is no guarantee of future results. Anybody needs additional information on these disclosures, go to tradestation.com/important dash information, and you'll find all the disclosure links there if you need them. Okay, so I am going to mute my microphone and pass the floor over to Brandon. Brandon, thank you so much for being here with us. I'm just going to stay quiet here and let you do your thing, okay?
Okay, no problem. Thank you. And welcome everyone. Just let's see here. I'll go ahead and share my desktop with you guys. Okay, so now you can see and hear me, which is great. And let me just go ahead and bring up the chat so I can go back and forth with you as well. And welcome back to another session of Options Replay. And this is for the 10th of November, 2025. This year is flying by. Hopefully it's not too cold out where you are, or if it is, that you're somewhere safe and warm. We'll go ahead and kick off. As Jesus mentioned, I'm not actually the employee of TradeStation. I was invited here to be able to talk to you guys about options and some of the option trades that I've been looking at for the week and how they might have shaken out, either winners or losers. We learn a lot from active positions in the markets, even if they don't win. We'll probably learn more from our losers perhaps than we do our winners, but we've got a little bit of both. And I'm going to play on the strategies that are taught or shown in the Options Education Center by TradeStation. So if you happen to cruise the website here, tradestation.com, under the Learn section, you've got Options Education, and TradeStation's done a great job of highlighting a lot of different strategies that are out there that can help you with your options trading. And you can explore those with different workshops as well as articles and videos on them as well. So that's where you can find that info. As for me, I'm a trader. Been doing this a long time, almost 30 years now, as a matter of fact. Started off in the financial markets as a retail broker, moved into back office operations because I didn't like sales. Basically, a broker's just a salesperson pushing different securities, and I wanted to get my hands dirty in the trading itself, and that's what I got into. I became a trader for brokerage, then moved into a private hedge fund, did that for a little bit, got a little burnt out. It's very high stress, and just started trading for myself. Went back and started doing some education as well, and realized that by teaching trading and investing, I was actually making myself a better trader and investor, because I'm not only saying what you're supposed to be doing, but I'm trying to lead by example, and it reiterates my rules and make sure I stick with them. So with that being said, and of course, if you have any questions along the way, please let me know. Anyway, one of the things I want to look at, oh no, that's the wrong symbol, RL, going back to one of the very first strategies that was discussed in the Options Education Center. Basically, if you scroll through all these, lots of popular strategies there. And one, we have straddle opportunities for earnings. And again, when you click on those, excuse me, bad allergies with the huge winds today. So you'll see there's a webinar about it. You got to explore the strategies. There's an article around that page, and there's even workspaces that you can use to help identify some of those strategies. I decided to deploy some of those strategies. And again, it's for straddles and strangles. I was actually looking at this particular security, Ralph Lauren. For some reason, it's not showing the earnings data right now, but the earnings were coming out, and they did actually already, on November 6th. So it wasn't too long ago. Let's see, which day is that? Oh, I was off by one. They actually beat earnings. So they were a surprise to the good side. And typically when you see earnings being met or exceeded, you would expect the stock to be rewarded. On that particular day, actually, I guess it was released on the 6th. So the next day, it actually gapped very slightly to the upside And since then, it's been trying to push to the upside as well, but that's not the real story. The real story is more what's going on down here and in what I call its volatility. And you can see, based on the strategy that was, again, in the options education center, when you go into that, they talk about the straddles and when to possibly look at those. And if you're not familiar, it's just simply buying two options, one call, one put. And your reward is if prices move far enough away. But right here is interesting. You want to take a look at your opportunities and possibly trade these straddles or strangles maybe 3 to 4 weeks before an earnings announcement. And the reason behind that is when you try to trade right at the announcement, which a lot of traders do, they try to put in the trade the day of or a couple days before. What you'll see is those options might be very overpriced. This is implied volatility, which I don't know why we're squinting. I can make those lines bigger. Anyway, you can see the blue is implied volatility for all options. The red is that average going back. I'm not sure. I think, it's 20 days. So roughly one trading month is counting. I believe it's only trading days. I have to check. Doesn't really matter. But basically, you can see when I was looking to get into the strategy, it was about a month, actually a little over a month before the earnings announcement. But look at where the volatility is. It was way below the average. I wouldn't say way below, but looking back, I guess this would have been much further below. It doesn't go below the average all too often. So when it goes below the average, options typically become less expensive. If we actually, let me go back. We look currently, now we are way below the average. We're actually still higher than we were back here, though. This was at 36, and we're currently sitting, actually about the same. Where were we here? Sorry, I was looking at the wrong number. There it is, 33. So we're still 3% higher than where we were. And when we take a look at the options, or L, there we go. I'll just go out, 38 days. And with the Greeks, we're basically dealing with Vega volatility. You can see that we've got about 0.43. So again, roughly 1 month ahead is what we're looking at. That means for every 1% we move, this premium will gain or lose 43 cents. Same thing on the put side there. And if we go out a little bit further, what you'll see is that volatility or Vega has more of an impact than it does on less time. So what happens is you're kind of trading different Greeks and different risk measurements when you change time frames. If we go to a very short time frame, which I'm still in some of these positions, you notice that the Vega is much, much smaller. About half is what it was. So let's take the 330, for example, on the call side, 43 cents. 330 here is only 22 cents. And if we go out to the further, it's 56 cents. Doesn't jump as much, but it does jump. Now, on the flip side, the further out you go, less time decay is going to be impacting you. The delta is going to be based on where the current price is, so that doesn't matter. We're looking at the at-the-money options, but we're trading out time value and volatility exposure. Both are risks, especially when you're buying options. We don't want to buy options that are going to decay too quickly. Notice these will decay at about 41 cents a day. Meanwhile, these are 21 cents a day, almost half. 16 cents per day, almost a third. But again, the further out you go, even though you're reducing your time risk, you are increasing your volatility risk. So this was actually put on, and that's why I put it on the chart here, back on the 23rd. And again, the reasons behind that, we were pretty much moving a bit sideways. You could see if I go back to that date, what the chart looked like. We were pretty much traveling nowhere, right around $310. And the volatility had dipped back below its average. So relatively cheap options in theory. You could also look, let's see, there we go, theoretical value. Now the markets are closed, so with the simulator may not give us the most accurate data, but this is showing a theoretical value again of the 330 for $9.74. That's showing that this is being overpriced currently, which again, after hours, it may not be completely accurate, unfortunately. And the same thing here, we're seeing that those prices right now for the bid ask are much higher than the theoretical value. Usually when the volatility is low, like it is currently, prices will be, you'll be able to trade for lower than or at theoretical value. Because again, volatility affects option prices probably more than any of the other Greeks combined. I was looking at, again, my thought process, we were probably going to go a bit sideways. However, we had earnings coming up. Looking back at previous earnings, this was not the best selection. And the reason why is when you go back in time on this particular security, oh, come on. you don't really see huge jumps. There are a few little gaps here and there, but you typically want something that's going to be a little more volatile, especially around the earnings. So you might look forward to something like Tesla. And next earnings date is not till January 28th. So we have some time for this. But again, when you take a look back, is my indicator on? No, maybe not. Let's see, studies. Under show me, I can use the EPS postings. And there we go. There you can see this is actually the day after. Let me zoom in so you can see it better. So right there shows when the earnings were released. And there we were actually getting some gaps. Granted, we're at about $250. So it seems like a small gap, but dollar wise, we closed 237.97, opened at 254. So that was a $7 move to the upside. Pretty good. Again, depending on how the options are priced. Another earnings release right there. This was in July of this year. We had closed 332, opened at 310. So over 20 points. Again, there's opportunity there if you pick the right securities. However, if you don't pick the right securities, you could get stuck moving a bit sideways and not working out the way you wanted to. So right here, again, I was right on volatility. It did go up, and you have to time this properly as well. The one indicator, in case you're wondering what I'm hiding there, that is the RSI. I actually use the RSI slightly different. I've mentioned this before. I use 30 and 70 for oversold and overbought, and I use it as a momentum indicator, not an oscillator. Most people, when they look at oscillators, they look at, okay, this is overbought. It's really high. So prices are probably going to come down because it's unsustainable. And if things are oversold, the indicator is very low, they say that, okay, it's probably going to rally. Actually, this is not correct. I just realized I had the wrong numbers there. But anyway, my point about that is it's not right, because if you have an overbought situation, you can become more overbought. That's a trend, basically. And that's what that's 70-30 is the default. I didn't realize it had switched back. I actually use 60 and 40. And the reason behind that, first of all, in a very strong bullish trend, you will not become oversold. And most people are looking to go oversold before they buy or become bullish on a security. It just won't happen. If you're that bullish, that strong of a bullish trend on that security, it will not become oversold. But if it does become oversold, that could be a signal the trend is reversing, or at least ending. So you see, going back here, not once has that RSI gone below 40, because we were in a bullish trend, and it just doesn't happen in a bullish trend. There's the last time it was. Now, the opposite is true. In a bearish trend, which you're seeing here, when you rally and make highs, you don't see the RSI going above 60. If you do, it's a pretty good signal to tell you that that's not a bullish trend anymore. Or sorry, bearish trend. You're probably reversing. And again, there's other things I look for, but that's one of the basics. And when you have very little momentum, as you see coming up here, it started calming down. And for the most part, we stayed pretty close to the center line around 50, although there were some spikes. But typically, if you're going above 60 and below 40 or staying between the two, you're probably moving in a sideways channel, which if you take a step back or even go to a weekly time frame, you can pretty much see that we were sideways trending for the month of September, October, and into November so far. Just moving sideways. Overall, a nice little channel to the upside. And I highlighted the channel I was looking at of 290 to 340. I figured, again, at that time, we're in the center. I was also looking at average true range for that security, definitely focusing on the low volatility so I could buy options that might be cheap. Back to the daily there, and actually I should move this back down, focus on price. But as I was saying, again, if you take a look, another indicator of volatility and possible movement is the average true range, or ATR. Where'd you go? Yep, too far. There it is. And I'll just keep the default. That's fine. So it pops up as an indicator right now. We're looking at 10.22. And you can actually look at average true ranges over a bigger period of time to get an idea of how much price movement you might have before those earnings get released. So going back to the 23rd of September, again, I'll go ahead and reduce. Actually, what I should do is disable. That's better when I'm not using them. So you can see that the average true range was a bit high, but coming down. Again, looking at bigger picture here and going back, you see it jumps down, comes down, jumps, comes down. That's average for the average true range. But at the time, we were only looking at about 8.34, and I can calculate based on the average true range and how much movement in the past the security has had, where we're likely to end up going forward, maybe 30 days. Again, it's just a guesstimate. And we can even look at the weekly average true range, which in that case has gone up, but at the time it was only about 17 and a half. And even the monthly. Now, when you're looking at this bigger time frame and this ATR, at the time I was looking to enter, we had an ATR of 37.94. We'll call it 38, round it to 38. So what does that mean? First of all, you're not going to get 100% of that ATR moving in your favor every single day. If we were in an uptrend and you had 100% of the ATR, you'd have nothing but solid green candles with no wicks. And that usually only happens when you're short, right? Anyway, hopefully it doesn't. And the same thing on the downside, you wouldn't have any wicks if you had the full ATR moving in your favor every single day. So again, going back to this time, we had about 38 for the average true range. And I want to get an idea of how much price movement we might have within the next 30 days. My ATR was 38. So bring up a calculator. On average, when you're looking at markets, again, you got to gauge by what it's been doing in the past and what the volatility is currently, the implied volatility on that security, because implied volatility is trying to predict how much movement you're going to have going forward for the next 30 days. So typically in a nice trend, you might only get 65 to 70% of the ATR moving in your favor every day. That's why candles have topping tails and bottom tails, those wicks. In a very strong trend, it might go as high as 80%, but you're very rarely going, and again, the ATR changes, but you're very rarely going to get 100% of the ATR in your favor in a trend on a given day. So if we were looking at roughly 38 and I do 0.7, that's 70%, that's 26.6. So to the upside, we are roughly going to move for the next month. Again, if we stick with roughly 70% of the ATR, about 26 points to the upside, and that would put me at 336. So 340 might be a safer area to be able to sell options above or expect prices to go beyond, or sorry, to just go up to that area, excuse me. And on the downside, 26 minus the 310, well, is a little bit inside, but at 290, we also see that was kind of the bottom of the recent range as well. So that was my rationale behind where this is likely to go. And I actually did another strategy as well. I'll show you in a moment. But prices did stay inside that range from 923. Where's 1023? There it is. That's almost exactly where it ended up. Roughly 70% of the ATR to the upside. And it's not really a surprise. It was to the upside. As I mentioned, we were in a kind of a, not really a strong trend, but a bullish trend, just starting to flatten out a little. So again, relatively cheap options, could get some price movement, wasn't very strong. And that was one of the mistakes I had. So going into the options themselves and manage, here we'll see the position. I probably should have been out of this already anyway, but there is a straddle and a strangle. If you're not familiar with those strategies, again, you can go into the Options Education Center. There's plenty of data there for you. And again, I just bought and sold a 310, bought both 310 call, 310 put for the straddle. For the strangle, you sell options further out of the money, and that's going to lower your overall cost. You're not going to pay as much for premium. In this case, where's the entry? Oh, the straddle was for 40.60 and the strangle was only 19.60, so it's half. Now they're both losing right now because I didn't exit when I should have, and that's okay. I just wanted to show you this strategy, so I kept it open even after the earnings. Okay, but typically what will happen, again, as options and volatility increases, or as volatility increases, options will typically increase in value. And where did I put it now? Apply volatility. There we go. And it should be back. And you can see that's exactly what happened. We didn't get a whole lot of price movement. And the earnings data, as a matter of fact, this was the earnings release. So the next morning, it opened up at 317.66. There was roughly a $7 move between the entry price or a strike price and where we actually opened. Not a huge move. And because of the time passing by, that was another error that I had also with this particular option. Currently, I only have 10 days left until expiration. That means that every single day, I was right there, every single day with 10 days left, 310 options right there, that theta is decaying that value. It's eating it up. And right now, that theta is greater than my vega. So I'm not making enough on the volatility moves to cover that theta. And of course, the volatility has dropped. At the time of entry, I'm not sure if I still have a picture of it. Let me see if I can find, apologize. I should be able to find it pretty quickly if I have it. And let's see, trades, RL. Okay. I think I do have it. There we go. And let's see. Oh, that was before. That was the 16th. Again, I was just looking at the markets. You can see what I was viewing and just what I was talking about, expecting prices to go a bit sideways. And we saw consolidation. And this is back on the 23rd of September. And what I'm trying to do is, there we go, straddle analysis and my chain even. There we go. So this was the straddle, again, buying the 310 strikes. And you can see that had a lot of premium. Actually, do I have the theoretical value here? You can see that these are overvalued right now. So I should not have been buying them to begin with. 1604 is the theoretical value for the call. It was trading even on the bid side well above that by $2 plus. And on the put side, again, theoretical value only $13, and this was trading well above that at 17 to 20. So there's no way around it. That was overpaying, and it was going to be very difficult to overcome that kind of premium. You have to have a big enough move in volatility as well as a big enough move in price. Unfortunately, it doesn't show the Vega here. It only shows the time decay and delta, but it should on this page. There we are. And yes, we have 98.88, which is almost 3 times the size of the theta. So again, I've got almost a neutral delta, so prices could go in either direction. That's fine. The deeper it goes, either the call or the put in the money, the more that delta will change. Of course, the opposite one will lose value. The time decay, that's my enemy, and I could have overcome a lot of that by using an option that would still have at least 30 days left to expiration at the time I'm exiting the position. Again, once you hit that 30 days left till expiration, that's where the time to value drops off a cliff. The 98.88, that was a nice Vega because, again, looking at the entry, we're at 33.32. This peaked at about 50. So what do we have? 27? Did I do that? Or 17? No, 50 minus 33, 17. So 17 points of volatility change, excuse me, times, what was it, 98 for the Vega? 98.88. I'm not getting exact, but that's fine. Overall, that increased the value of those options by about $1,680. Talking about the entire position, because again, the call and put will go up in value with the volatility going up based on that Vega. Of course, things do change as prices move, obviously. You can play around with that inside of the OptionStation Pro by playing, again, if we go to analysis page right there, under analysis, when you're looking at your price slices, you can change volatility here. And you can see with the price slices, the changes in price, as well as time. I go into your graph and selecting multiple times. And you can see how it would move and how it would profit and or lose. You know, where are the risks, where are the gains? So in this case, I had a lot of volatility. However, again, that theta starts increasing quite a bit the closer you get to expiration. So at entry, it was 31.92. Where are we now? That's the better position here on Condor. Where are you? Strangle. Oh, let's scroll up a little bit here. There it is, straddle. And you can see the volatility has collapsed down to 25. And now every day I hold on to that, I'm losing double what I would gain in volatility. And of course, volatility is collapsing. Volatility is also an investor fear gauge, if you will. The closer you get to an unknown event, okay, remember, this is earnings right here. And the closer you get to an unknown event, the more people are going to be fearful of a sharp price move in either direction. Okay, nobody knows what the earnings are going to be. So when there's a great unknown, there's going to be a lot of fear around that, and people are going to demand more premium to sell options. Typically, you're going to see the volatility peak anywhere from 2 to 7 days prior to the announcement. Again, it's going to be different for every security, and you can look back at previous announcements to get an idea. We can look at another security like Apple, which also has, well, maybe not. Let's give me some bad data. We'll go back to Tesla, or we can check a few others as well, and make sure that study is still there. EPS postings, and it's off. Turn it on, remove the duplicate. There we go. And there is the that's the release. This was the earnings date right here. This one actually did not drop in this case. That's unusual. It actually increased volatility going past. But typically you'll see a very similar pattern. There it is. There's the earnings date, roughly a month before the earnings. Let's see, this was on 7/24. This one still had high volatility, even though it was below the average. And I'd have to look back to see, is that relatively high or low compared to where it's been? And this one was, this would have tricked us because based on, there it is, 24th, I would have expected volatility to be relatively low and going up. And in this case, it dipped first, then it went up, but it only went back up to where it was just before the earnings. You can see we peaked right about the 18th. Earnings came out on the 23rd, 22nd. I'm sorry, no, 23rd. I was right. So it was just a few days before. And again, going back, here's another earnings date. It was released on the 22nd and actually peaked pretty much right on the earnings date, although it did have a big peak back here, back on the 8th. But once again, going from 423 to roughly 323, right around here, you can see there was a dip in volatility roughly a month before the earnings. And you could always exit early if you have a really nice profit from that volatility move. And on that date, roughly 321, about a month before, if you waited until Monday, again, volatility was low, 71%, relatively speaking. It moved all the way up to 112%. So over 50 points of volatility right there. That's an opportunity. Much more on the volatility than on the price movement. Because again, let me put in a vertical line here to make it easier. Here's the peak of volatility. And this would have been the entry point roughly. You can see that price didn't really move much between the two. As a matter of fact, it just went down a little bit. And even from entry area right around 247, it only moved up to 289. So about 40, 50 points. It was still a pretty good move, but the delta is not going to give you a whole lot. Remember, you have almost a neutral delta. Where are we here? Now it's greater because prices have moved, but upon the entry, that's what I was looking for. There, we are long a call and a put, and you got positive delta, negative delta. You might have a slight bias, but you're going to be pretty close to neutral. So I'm trying to play that volatility increase and profit from that without sacrificing too much on time. And again, this one just wasn't right. It was going back to RL, a little too quiet of a security, so it didn't have as big of a jump of volatility. Although, again, it was something. And if I had gotten out on this particular day, there was 17 points of volatility, and it would have been a nice profit, even though prices didn't move a whole lot. You can see, again, this was the entry date, that's the earnings date, but the peak of volatility getting out a few days before, even if you mistimed it a day or two, still had pretty good volatility up there compared to where you were. And the price, let's see, trend line. Is that it? No. I always forget which one's a trend line tool now. Yeah, that's it. Anyway, if we were getting in somewhere around here and exiting, you can see the price did not move all that dramatically, 309 to about 319, 10 points. And at the time, with 992 as your delta, you're not going to profit a whole lot. Okay. I say, oh, it was 19. It's about $10. It's $190 in delta. That's not worth much. It's all about that Vega. And again, controlling the theta. Now, the other position I looked at, let's see, and took is an iron condor, but actually should have done probably, it's okay to do this one as well, but it probably could have done the opposite of the iron condor, which is selling rather than buying the iron condor. In this case, volatility was very low. So again, I want to be on the buy side, not the sell side, typically, because I want to buy cheap options. Where is iron condor chain? Oh, I didn't take a picture of this. This was what it looked like on the entry date. So I don't have the Vega, unfortunately. That's what I really wanted. You can see my time decay is almost nil in comparison to what we were looking at before on the straddle. And the delta, again, almost nothing. We can go in either direction potentially for profit. I don't have a bullish or bearish bias. And I'm a little bummed I don't have the Vega here. Taking a look to see if I had it anywhere else. We see screenshot. No. Straddle analysis, strangle analysis. That's really weird. I didn't do it. Missed a picture. Shame on me. But again, if we take a look at the current moves on this security, manage. Again, the iron condor was profitable. Right now, it's down about 887. The reason why is, again, that volatility was up and I had a good profit in the position. But if you do not exit until after the announcement, look what happened to all that profit of volatility. We went from, again, about 50 to 36 where we are right now. We gave up all of that. And that's why it's actually a negative position. It was in a very good positive position. I apologize. I should have taken a picture at the time. But again, we learn from these things as well. So if you're looking to deploy that kind of strategy, let's see, I do have workspaces. I should have had it downloaded. Hopefully I do. Straddles for earnings. There we go. I'm trying to see if I have another one as well to look at. If not, let's move that out of the way. There we go. Let's bring up the workspace now. Hopefully. That's collars. I did some collars too. I can go over those. Straddle, strangle, iron condor, vertical. Okay. So again, on the Options Education Center, as I mentioned before, there are workspaces that you can download right there, download workspace, and it'll provide you with a workspace to get started looking for some of these opportunities. And basically what I'm doing right now, I think I only have the S&P 500 index as default, but we can look to see, and actually this is not set up correctly because I messed around with it. So next earnings date should be at least 25 days out, but not greater than, we'll say 35. I'm trying to find that sweet spot where that implied volatility is relatively low. So right here, implied volatility versus historic. I want open interest to be somewhat high, so we can actually, again, be able to get in and out liquidity. And actually, I think I want to change this around a little bit. And I don't have that indicator on, so I'm going to add a study. There we go. And I can look for implied volatility to be below the average. Yeah, we're looking for relatively cheap options, and typically when implied volatility is relatively low, that's where you're going to find it. So I'll include that one. Yeah, I can leave that there. And now I can go ahead and put in a scan for it as well. So we do have a small number of securities that are getting ready to do their earnings coming up. You can see 28 to 31 days, not too bad. However, I want to see how that implied volatility is. I could just go ahead and look on the charts as well, obviously. Why is this not? Oh, I have to select it first. That's why. So I go to implied volatility, all. I want it to be less than the IV average. I think I had something else in there already. Oh, IV range percent. That also is something that was an indicator that Jesus built. If we go, sorry, that's the wrong spot. If I go off to the right here, you'll see the range percent. What this is trying to do is figure out if the implied volatility is relatively low compared to the historic volatility range. So it's an indicator that Jesus and I worked on together. And where is it here? Studies, add. I think you can also put it on the chart if I have it. There it is. You'll see two. Hold on. X, is that the right one? No. Trying to help you to be able to see this. I actually have a tool on my computer. Come on, called Zoom It. Just trying to get it running. There we go. Alt Z should work. Okay, there we are. So what I wanted to point out on this indicator, it's available when you go to the download for the workspace. It'll download the indicators there as well. So anyway, with this indicator, if I go back, you'll notice there's two. There's one that says RS, and then there's CH. RS stands for radar screen, CH stands for chart. So basically, I'm working on the chart. I'm going to add that one to my chart and hit OK. Of course, I put it right on top of another indicator by mistake. So let's do this. Edit and move it to a separate subgraph. Should have automatically done that, but it didn't. We'll do, there we go, 4. There it is. So basically, like I said, what this is doing is creating a range based on the last 52-week historic volatility. And that range, the 52-week low becomes 0, the 52-week high becomes 100, and then it's plotting the implied volatility current against that. If we want to buy options, we obviously want to buy cheap options. So its cutoff right there is at 40% on the scan. I typically want to find implied volatility in that lower 40% range. So it's relatively inexpensive options I'm looking to buy. So I'll disable, or I could have removed it, but that's okay. If we go back to the radar screen, you'll see there it is, IV range percent and range percentage. None of these are below 40. So unfortunately, we might have somewhat high volatility, and therefore they may not be the best opportunities for this particular strategy. So we'll click on Oracle, take a look at this real quick, go in. Again, we've got about 28 days left until the earnings. Implied volatility has come off of its lows, so the options may not be as cheap as I'd like. You kind of see that right here. We're a little off the dips that we've been. We're still below the average, however, which is not bad. We can even take a look at, this is implied volatility divided by historic, and it's not so great. Again, we want to be in the low area for the cheapest options. So if we were to take a look at the option chain, oh, I moved it to the other page. There we go. Options. And we'll go about 30 days or so. Let's see, Oracle's right. Again, we're seeing that we're overvalued. Again, I'm not sure if this is accurate as of right now after hours, but it does look like these options are overpriced, which obviously I'm not going to want to buy overpriced options. So we just continue to look and minimize that. Get back to my other screen. Apologize, my computer's running a little slow today. We've got Broadcom, Synopsys, Adobe. So there are a few others, but again, we do have the options. The earnings coming out in the right window, but our implied volatility is not really that low compared to the average. I can see it right here in the radar screen rather than looking at the charts. It shows all an average, and it's just not working out. So let's see if I add in another index here for securities to search. Whoops, add symbol. And we can add maybe the NASDAQ 100. I know there's probably going to be some overlap there as well. There we go. And boom, pretty much the same names, isn't it? Okay, again, go into data. I don't know if I have another list I could add. Oh, we had more, but not too many more. And you can create your own symbol list or look at others. There we go, trade stations. And if we know there's a particular sector that might be relatively low volatility, you could look for that as well. And if you don't know which ones might have low volatility, you can even create a list with some of the ETFs that track those sectors, and that'll give you an idea of how volatile those sectors are. So again, if I were to go, let's create a new watch list here, or actually I have one already, and we could do, let's see, XLY, I'm trying to remember all of them now. That's consumer discretionary. We have XLK, technology. I'm just going off the top of my head. XLU, utilities, XL, is it V for healthcare? Yeah. XLF for finance. Ugh, cannot remember all of them right now off the top of my head. I'll just go to stockcharts.com. That'll help me out. Charts and tools. Where is it here? Interactive performance charts, maybe. That's not the one. I'm getting closer. Where are you? They have a performance chart for the overall market, and it'll show me the different ETFs. I cannot remember where it is, of course, right now. I'm not sure if I could check. No, I can't do that here with this. I need to try. I can't remember where it is. They changed the website a bit. Here's a sector drill down, but oh, there it is, sector performance chart. That's what I want. Okay. And, oh, there they are. So I'll pull this off the page for a moment. And now I've got them all. So we have XLY already, communications. We need XLC. What else do we have? XLK. I already have that, don't I? Yes. XLI for industrials. XLB for builders, building materials. XLP, consumer staples. What am I missing now? XLRE for real estate. Let's see what we got here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I think that's it. 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Now I'm missing one. Dang it. Y, K, C, of XLC, yes. XLI, that's there. B, XLE, energy, that's the one I missed. There we go. So again, what I'm using, in case you're wondering, I went to stockcharts.com, market analysis, and right there, sector performance chart. It's showing me how they're performing against each other or against the S&P 500. That's against the S&P. And there are the ETFs that I was using right there. That's how they're performing without the S&P, just against each other altogether. So we probably would have technology with high volatility, and we're probably looking at maybe energy, materials, or healthcare with relatively low, but let's see. So obviously there's not earnings data on that. These are just the ETFs. And what I'm trying to do is narrow down the sector that I might want to be looking for low volatility options opportunities. And you can see historical volatility is being shown, but I'm not seeing, let's see, apply volatility and range. There it is. Range percent. XLV is very low. And that was, I forgot which one V was. I believe that is healthcare. Yes. So healthcare seems to be relatively low volatility right now. We also have real estate. And the reason why I brought that up now is, again, if I go back to my page 1 in my lists here, I added the NASDAQ and the S&P, but now I can go into symbol lists, other symbol lists, and see. If not, I can create one. But I believe TradeStation has some sector lists, or at least industry groups. There we go. So we saw that healthcare, and I can start adding some of these to see if healthcare actually does have relatively low volatility. So can I add more than one? No, just one at a time. unfortunately. So we'll go that. So I'm going to add the list. Thought I had. So again, we'll go add symbol list. Again, other symbol lists. Oh, actually here, no, that's not really what I want. Those are futures, I believe. So again, I go to industry groups in this case, not really sectors per se, but industry groups. And we go to healthcare. Let's see, view symbols. There it goes. That's what I forgot to do is add the symbols in. Then I hit OK and it should populate now. I hope, unless I did something else wrong. That's really weird. Try it again. I can also create my own personal symbol list, but that takes a little bit of time as well. I'm not going to do it. But I'm just trying to find, like I said, some possible opportunities. If this doesn't work again, then I'll just move on. So again, view the symbols. Great. We got a nice list of about 30 something. And that's my list. So it should add it. There it goes. Finally, I don't know what I did wrong before, but there we have it. And of course, none of them fit the criteria. I was looking for implied volatility to be below the average, of course, and open interest to be at least 10,000. So that wasn't it. So something's cutting it off. It must be the earnings, possibly. They don't have any earnings coming up. So again, I can just go ahead and look for another list, other symbol list, industry groups again. What else we have that was low? That was on the other page, of course. If I go back to, oh, real estate was low as well. Let's see, do we have real estate? Real estate, there it is. And we have real estate, view the symbols. So we should have the real estate symbols. There we are. Okay. Try one more time here. Industry groups, real estate. We had real estate, view the symbols. There. Okay. Okay. And please add them. There we are. And it should automatically start to sort. And once again, I just don't have anything that meets the criteria, so that's okay. I'm not going to keep doing this over and over again, but I would if I'm looking for trade opportunities. For now, looks like Adobe has relatively low volatility, although the indicators are not working as well as they probably should. But I could take a look at Adobe, which has next earnings on December 10th. So here's the thing again for choosing. And one thing I want to make sure of is I don't make the same mistake again because I know better. I want to make sure I have enough time, but I still want to build volatility in my favor. So going further out in time is going to help me with both of those because I'll have less theta to deal with and I'll have a greater vega to profit from volatility rising. First of all, before I go there, I should also go back and I'll bring it up on this chart, Adobe, and we see implied volatility all over the place. So I'm not sure if that's accurate, but again, studies, edit. I want to see the pattern of how this reacted to previous earnings. So right here, EPS postings is off. I'm going to turn it on. And it's a show me. So I'll be able to see the past earnings releases. There we are. And that's weird, but volatility looks like it grew. See if we get some better data going back. There we are. That's the kind of pattern I'm looking for. A big jump in price for one on earnings. That'll help the delta a little bit in the price movement. But secondly, look at that change in volatility. So we had earnings release on the 12th of June. If we go back about a month, about May 12th, there we are. Go ahead and mark those so don't forget. May 12th, June 12th. That was the earnings release because that's the day after. And you can see that volatility actually spiked before and then on the day of the earnings release. Going back though, roughly a month before the earnings release, you can see the implied volatility is right around 34. It was at the average, missed the perfect window, but if you waited a little bit, you saw implied volatility start to go down. And it wasn't too much of a drop, about 3%, but every little bit counts. The next day, if you waited off that bottom, then it started jumping back up again to 34. So you could have gotten it around 34%. You had a few different opportunities there. And it went all the way up to about 56%. So we rose, 33 points? 32 points, roughly. And even on the day of the earnings release is at 56. So again, we're looking at about 32 points of volatility. And if we play this right, we should get a big amount of volatility adjustments again, where it goes from very low 30 days ahead to very high on the earnings release. Again, going back, same thing happened here. Earnings were on March 12th, on February 12th. There we are. And it was just above the average, but look at that change from 29%, we'll call it 30%, up to 63%. That's a huge move in volatility. So again, it's all about getting the right options then. Once more, we had how many days until the earnings currently? The December 10th. So back on this page for Adobe. 30 days. So we need something that's going to be at least 60 days until expiration. We have the January options. Now, why would I choose those over the December? Right now, we're trading about 329, so we would do the 330 options. I could buy 330 call, 330 put. It's going to go. There it goes. Oh, what is happening there? So buy the call, buy the put, and I'll do the natural price rather than the mid and analyze. And there's the straddle. Now let's go back and do the right one. 330 call, 330 put, get rid of the Decembers and analyze. So now we can compare the two and see what the difference would be. So our deltas, again, not really much of an issue because you're long a call, long a put. You got positive, negative delta canceling each other out, slight bias. Time decay, we have 52 on the shorter time frame December. We only have 36 on the longer time frame. So we've reduced some of that time decay. But here's the kicker: volatility. Look at that change. So again, this is all theoretical pricing, but in theory, if we see a move similar to what we've had before, come on, go back. With Adobe on earnings, where's my previous earnings date? I had all my lines. Oh, it turned it off again, didn't it? I don't know why it happens. As studies. Sorry, I got to keep it on time. We're almost done here. I got to bug out soon. On. There we go. I was wondering why it disappeared. So for instance, we'll use this one right here. This is the closest. And that was the March 12th. So February 12th, the volatility went from 30, again, getting out a few days before to be smart, to about 58. So 18 points of volatility, right? So we're looking at 18 points of volatility, and the Vega here is 85.44. That means we've got about a $1,500 potential profit just from volatility rising. However, with the longer volatility, 18 times 111, more profit. Not a huge difference, but it's definitely a difference. And the other thing is we're going 30 days in time. So we're going to lose about 52.63 per day. 1578. Remember, it was 18 points of volatility times 85.44. I'll use the more accurate. It looks like our theta is going to eat up all of our volatility, isn't it? Let me make sure I did this math right. It was 1537.92, and we're going to have to end on this. Again, it was time decay, 52.63 times 30 days, 1578. Yeah, that's actually bigger than the 1532 that we're getting for the volatility. Here, we have 36 times 30 days, and that's 1,000. And 111.69 times 18 points of volatility, that's almost $1,000 profit if you choose the right option. If you chose the wrong option, it was about a $300 loss. That makes a big difference. We want to make sure we have enough volatility and we're able to overcome the theta, because if you start going too soon and you have less than 30 days till expiration, that theta is going to jump. Right now, it's got enough, but it's not going to be enough as time goes by. So again, yeah, you got 8 days before it hits that 30 and you're done. So I want to thank you guys for having me here. Hopefully I answered a lot of your questions about some of the strategies we can do with earnings and really what the focus might want to be on. Make sure you time it roughly 30 days prior to the earnings release. Again, the details are right on the website. If you go to TradeStation.com and you go to the Options Education Center, you can go right to the straddle opportunities for earnings. And it even says in the article when you might want to put these on. Now you know what to look for as well with the timing and the volatility changes. So thank you, Jesus, for having me. If there's any questions I can answer quickly, let me know. I didn't see anybody typing anything in the chat, so I guess we're okay.
Yeah, let me go ahead and send that email address here in the chat as well.
Oh, right.
I know many of the attendees already have it, so they know who to contact whenever they have any questions. Brandon, thank you again for your time. Thank you for your expertise. Everyone, please check our event calendar. We always have new topics coming up. Remember that options replay is a recurring session. I didn't post a link here in the chat, but I'll do it right away. This is where you find the recordings. And that's where we post all prior sessions of options replay. So make sure you visit, and they're titled differently so you know what are the topics that we cover there. So that way you're not lost in so many different videos. Brandon, again, thank you. Everyone, have a wonderful evening, and I'll see you next time. Thanks for coming. Bye bye.